When investing in the stock market, one of the most attractive features for many investors is the ability to generate income through dividends. This brings us to an important concept known as dividend yield. Dividend yield is a financial ratio that tells investors how much a company pays out in dividends each year relative to its stock price. It is an essential metric for those seeking to evaluate the cash return on their investment. To calculate dividend yield, you simply take the annual dividends paid by a company per share and divide it by the current share price. For example, if a company pays a dividend of $1 per share and its current stock price is $20, the dividend yield would be 5%. This means that for every $100 invested, an investor can expect to earn $5 in dividends annually. Understanding dividend yield is particularly crucial for income-focused investors, such as retirees who rely on dividends for their living expenses. A higher dividend yield can be very appealing, but it's important to look deeper. A high yield might indicate an undervalued stock, or it could be a warning signal that the company is facing financial difficulties. Therefore, while the yield is a significant factor, it should not be the only consideration when evaluating a stock. Investors should also assess the company's history of dividend payments. A consistent history of paying and increasing dividends over time can be a sign of a stable and financially healthy company. Companies that have consistently increased their dividends are often referred to as dividend aristocrats. These are companies that have raised their dividends for at least 25 consecutive years. Investing in dividend aristocrats can provide not only regular income, but also potential for capital appreciation. Moreover, it is essential to consider the payout ratio, which is the proportion of earnings a company pays to its shareholders in dividends. A payout ratio that is too high may suggest that a company is paying out more in dividends than it can sustain, potentially leading to cuts in the future. A payout ratio of around 40 to 60% is generally considered healthy, allowing enough earnings to be retained for growth while still rewarding shareholders. Another critical aspect to consider is the overall growth potential of the company. A company that fails to grow may struggle to maintain its dividend payments over time. Investors should look for companies with a solid business model, competitive advantages, and a clear path for growth. The combination of a reasonable dividend yield, a sustainable payout ratio, and strong growth potential can lead to a robust investment. It's also worth noting that dividend yields can fluctuate based on market conditions and changes in stock prices. For example, during a market downturn, stock prices may fall, leading to an artificially high dividend yield. This situation can be misleading. Thus, performing thorough research and analysis is crucial. Lastly, keep in mind that while dividends can provide a steady income stream, they are not guaranteed. Companies can reduce or eliminate dividends at any time based on their financial performance. Therefore, diversifying your portfolio and not relying solely on dividend stocks can mitigate risks associated with dividend cuts. In conclusion, dividend yield serves as a valuable tool for investors seeking cash returns from their investments. By understanding this metric, along with factors such as payout ratios, historical payment trends, and growth potential, investors can make informed decisions. Dividend stocks can be a great addition to an investment portfolio, especially for those looking for income. However, it is essential to approach them with a cautious and informed mindset, ensuring a balanced and diversified investment strategy. Ultimately, the aim is to achieve not only income through dividends, but also overall financial growth and stability.